Hi, my name is Hina Ibarra, and today we'll be talking about American Chemical Corporation, their Collinsville plant, and Dixon Corporation. In order to assess the past performance of American Chemical Corporation, I looked at the company's financial statements prior to the acquisition of the Universal. As shown in the table, we can see sales, net income, net profit margin, and earnings per share for the years 1974 through 1978. ACC experienced a decline in 1975, but this was spread across the industry. The economy was in a recession and there was a decrease in demand for the product. After 1975, the company steadily increased sales. As shown in the table, there was a constant percentage increase after 1975, with a significant increase from 1976 to 1977. Net profit margin is the percentage of sales that the company retains after all expenses have been paid. Net profit margin is calculated by dividing net income by net sales. After the recession of 1975, ACC had a steady increase in net profit margin. This is a good sign for a company. In 1978, it had an increase of net profit margin of 1.57% from 1977. Earnings per share indicates how profitable a company is. In the case of ACC, they showed a steady increase in EPS after 1975, and in 1978 they had an EPS higher than they did before the recession. ACC seems to have a stable lead in the chemical chloride industry. They are one of the biggest diversified chemical companies. There are only 12 producers in the market, with only a few more trying to break in. ACC is in the top 3 of those 12, producing around 65,000 tons a year, with their Collinsville plant producing 40,000 tons of it. This is 19% of the domestic production. In order to determine the unlevered and leveraged beta for Collinsville plant, you had to look at two plants that were similar in size and product. Collinsville is able to produce 40,000 tons of sodium chloride. International Minerals and Chemical Corporation also has the capacity to produce 40,000 tons. Pennwalt Corporation overall can produce 72,000 tons. However, one of their plants can produce up to 37,000 tons, so we are using this as our second company. The unlevered beta is then calculated for each company. The average of the two unlevered betas then gives us the unlevered beta for Collinsville. The levered beta is then calculated by average of unlevered betas divided by 1 plus debt over equity. The debt over equity ratio is figured out by using the debt over equity after the takeover of Collinsville. This means adding $12 million purchase price to Dixon's debt. This gives us an unlevered beta for Collinsville of 0.70, which then gives Collinsville a levered beta of 1.56. By using the formulas shown here in the PowerPoint, we can determine cost of equity, cost of debt, and the WACC. Cost of equity comes out to 21.2%, cost of debt 5.85%, and WACC at 15.83%. The net present value of the Collinsville plant without the technology in 5 years is $159,000. After 10 years, there is a negative NPV of $3.7 million. This does not look good for Dixon. Dixon would be losing money in the investment if they chose to acquire Collinsville without the laminate technology. In order to install the laminate technology, Dixon would have to pay $2.25 million. However, the investment would pay off. It would provide a present value cash flow of $3.4 million and a net present value of the acquisition of $5.7 million. The positive NPV shows that it would be wise for Dixon to pay for the installation of the laminate technology. The range value for Collinsville would be from a negative $3.8 million to $5.7 million. Collinsville is attractive on economic and financial grounds only if they install laminate technology. The laminate technology will help cut down variable costs, provide a positive NPV. There is also an increase for demand in sodium chloride, so it seems like a good idea to get into the business. Collinsville is a good strategic fit for Dixon. It meets with the company core needs. It allows them to expand their product. They do not have to worry about costs with finding new clients because they are already doing business with Collinsville clients. It will also allow Dixon to increase their current production. ACC has also said they will provide Dixon with information regarding all new technology related to the plant. This can help cut down on R&D costs. Dixon's management has to consider if they are willing to have their capital debt ratio increase from their target of 35% to 47%. This will have a negative impact on the company. Their bond rating will go down while the debt ratio is at that level. Their cost of debt will also increase if the company is in need of borrowing capital. The power cost of the plant is going to continue to rise at a 12% rate. This is actually higher than the rate of the 8% annual increase in sales price per ton. However, if Dixon Corporation does want to go through with the acquiring of Collinsville, they need to spend the additional $2.25 million to install the laminate technology. This in the long run will help reduce costs and increase profit. The proposed financing for Collinsville would increase Dixon's debt by $12 million and raise their capital debt ratio to 47%. The loan rate is 11.75%. Despite the increase in debt, Dixon could meet its financial obligation if they chose to acquire Collinsville. There is a steady increase in the demand for sodium chloride as well as an increase in profit margin. These are a good sign for Dixon to take a jump and acquire Collinsville with the laminate technology.